This is Kyrill Asatur, and this is Centerfin Capital's Collective Weekly for the week ending May 10th, 2024. As always, we like to highlight a handful of things that happened this week that are relevant to markets and investing. This was a lighter week in terms of macroeconomic data and earnings data, but we wanted to really recap earnings. Most earnings are done for this quarter. There are still some notable earnings left, but we wanted to highlight some of the things that we took away from this earnings season. Next, we'll discuss the European economic situation, which has been very different from the U.S. economic situation. Last, we'll discuss the Japanese yen, which is a little bit more of a wonkier topic, but we think it's important to highlight to you folks. Starting with earnings. So we're largely through earnings season. There's still some notable companies, particularly NVIDIA, which reports in a week and a half, but most companies have reported earnings, and the results have been better than expected. Earnings were up about 5.2% year over year. For the quarter, expectations were 3.4%. And so the markets have reacted positively. The stock market, since earnings season started, has rebounded from a slight drawdown in April, which we discussed last week. And the one thing we wanted to highlight about that earnings growth is that is not inflation adjusted, right? So that's not real growth. That includes inflation. So if you think about it in that way, inflation has been running about between 3 and 4% year over year. So earnings up a little over 5% year over year mean that just adjusting for inflation, earnings are up a little over 1% year over year. So still good growth, but it's not 5% growth, which is the headline number. Really, if you adjust for inflation, it's a little over 1%. That being said, there was a lot of positives to take away, including the fact that CEOs seem to be optimistic. There's less talk about recessions than there were a year ago. Generally speaking, if the CEOs in the C-suite is more optimistic about the macro environment and the economy, they're bound to act accordingly. And instead of battening the hatches, they will act in a way that generates growth for their companies. And that's definitely a positive. The other thing that was a big takeaway was that buybacks, so stock buybacks, which has been a major force in the markets for the last decade plus, were up 16% year over year. So last quarter, companies reported $181 billion of stock buybacks, which is up 16% year over year. Apple reported that they plan on buying back $110 billion of stock this year, which is a massive number, and the stock rallied on that number. Goldman currently forecasts that for the full year, there's going to be $925 billion of buybacks in 2024 and over $1 trillion of buybacks in 2025. Now, what does that mean? Why is it important? Buybacks are a way to boost earnings, right? If you're buying back shares off the market, your earnings per share will grow because you're decreasing the denominator, right? But it doesn't mean that you're organically growing your business, right? This is more financial engineering than it is actually organically growing your business. Buybacks have been a big part of what's been driving the stock market in addition to passive flows over the last decade or so. It looks like the trend is continuing. So it's something to be cognizant of. Now, you can argue that buybacks are financial engineering, so it doesn't mean that earnings are organically actually growing in a natural progression of things. If a company is doing well, their revenues are growing and they're managing expenses and their earnings are growing. And so the stocks should be going up because of that. If the earnings are growing just because of buybacks, then the stocks are going up just because they're taking shares off the market. In the long term, things will normalize and fundamentals will prevail. But in the short term, it's very important to be cognizant of the fact that next year there's going to be $1 trillion of buybacks, which is a massive number. And this is also relevant to the fact that stock-based employee compensation has become a very regular thing for publicly traded companies. And that's dilutive, meaning that every time an employee exercises stock options, that actually adds shares to the publicly traded float. And so the buybacks are also a way of managing that as well. It's anti-dilutive versus the stock-based compensation that goes on. Just an important thing to highlight because it has been a trend. It is going to continue to drive things in the short term at least, but it was a big thing that we thought was very relevant to highlight out of the first quarter's earnings season. Next, we'll discuss the European economy. So the European economy actually hasn't fared as well as the U.S. economy post this interest rate hiking cycle that the central banks globally have been on since 2021, 2022 or so. The European economy actually last year was relatively flat. Two of the biggest economies, Germany and the UK, actually experienced some decreases in GDP. The UK was technically in a recession towards the end of the year. The thing to note is that central banks kept interest rates high. Most of the central banks have not cut interest rates despite the lack of growth. the economies in the first quarter seem to have rebounded a little bit. So both in Germany and the UK, after showing a couple of quarters of decline in GDP, the first quarter indication was that GDP was growing again. This notion that higher interest rates were not going to be able to be absorbed by economies globally because we've been living in the zero interest rate environment is really false. I think the economies have actually handled these higher interest rates better. Now, in Europe, the reason why they had an actual flattening of growth and decline in some of the economies is because in Europe, we have a very different interest rate kind of product regime. So most mortgages in the US, as you guys know, are fixed mortgages for long periods of time. A lot of consumers took out mortgages pre-rate hikes at very low levels. These rate hikes have not affected them. Their monthly payments have not gone up because of the rate hikes. In Europe, what's really different is that they have much more shorter term and floating rate mortgage products and other consumer credit products. That's why we think that there's been a little bit more of a flow through to the economy than there has been in the US. But at the same time, as I was saying before, it looks while 2023 was a flat year for economic growth in Europe, it seems like it's rebounded in the first quarter. To be determined, Sweden just cut interest rates for the first time since the hiking cycle. So we'll see if the broader central banks follow. For now, it looks like the economy is able to handle the higher interest rates that we've been living in for the last couple of years. Last but not least, the Japanese yen. So this is in the wonky corner, as we call it, because this is a little bit far out for most folks in terms of what they focus on. But Japan is the third largest economy in the world. It's obviously something that is important. The Japanese yen versus the dollar has declined this year through the end of April by about 15%. That's a massive move for a big developed market like Japan. When the currency gets weak, that's actually inflationary domestically. It's good for exports because it makes Japanese goods outside of Japan cheaper, but it's bad for things that they need to import. And Japan needs to import a lot of things. The consumers feel it and it becomes inflationary domestically. So the Japanese government does need to manage that. And they did so at the end of April, early May. They intervened by selling dollars, buying yen in order to prop up the value of the yen. And so just to give you a sense of numbers, we started this year with dollar yen at 140. It went to 160 in 4 months, which is, again, a massive move. The Ministry of Finance, the equivalent of the Treasury in Japan, intervened about a week ago, selling dollars and buying yen, drove it down to about 150 yen to the dollar. But now it's trading up close to 156 again. It was a very temporary effect. Why is that important? It's important because two things. One is the other way that Japan can fight this is by letting interest rates go higher. And they can't really afford that because they have the largest debt to GDP ratio in the whole world, in the whole developed world. They're at 263% debt to GDP. In the US, we're at about 120% debt to GDP. That just means that higher interest rates are just a massive burden on the federal government, something we've discussed in the U.S. as a potential risk down the line. The other thing why it's important to highlight is because what lower yen means is domestic inflationary pressure. So something has to give, right? So they can continue to intervene and sell their foreign currency reserves, which is actually negative for the value of the dollar and negative for U.S. interest rates, meaning it will put pressure higher on interest rates, because most foreign currency reserves are held in U.S. treasuries, or they can let interest rates go higher, and they can't really let interest rates go higher. It'll likely mean that they will be dumping U.S. treasuries into the market, which will put upward pressure on U.S. interest rates, which we've discussed is not good for U.S. economy, not good for U.S. risk asset. It's in line with a theme, which is the fact that the U.S. dollar being the global reserve currency, which it's been since the end of World War II, basically, is being threatened. Countries like China and Russia are very keen to get off the US dollar standard. This does not help in that matter. It's something we follow. Japan, as we've also discussed, is one of the leading indicators of this quantitative easing, zero interest rate policy regime that they started in the early 1990s. The US has followed, obviously, post the global financial crisis. And so we also view it as something as a guide for what we can potentially expect in the U.S. And so if you follow the breadcrumbs, what that could mean for the U.S. is Federal Reserve, the central bank in the U.S., monetizing the debt, just like the Bank of Japan has bought a lot of the Japanese government bonds over the last couple of decades and own about 40% of the market there. In the U.S., the Federal Reserve may have to resort to the same thing. And that, again, has ramifications on lots of things, including inflation. In this day and age, inflation is a very important thing to not just protect your purchasing power, but also your wealth. And it's a little wonky for most, but something we thought was interesting to highlight. As always, drop us any comments, questions, or concerns that you might have, and we will see you next week.